So a few weeks ago, Nike released their quarterly results, and the results were much worse than investors had anticipated. Basically, they reported full year 2024 revenues that were essentially flat from the prior year, and then their Q4 revenues were actually down 2% on a year-over-year basis. And then also Nike Direct, which this encompasses both their e-commerce sales and also their sales at Nike branded stores, was down 8% on a year-over-year basis. And the reasons they cited for this was very generally just poor macroeconomic conditions. And then in China, which is one of their biggest individual markets, they said that consumer traffic was down as much as double digits versus the prior year. And then they also gave guidance for next fiscal year 2025, saying that revenue will likely be down in the mid-single digit range. Now, the stock overall is down, as we can see here, 32% year to date. And actually, before they released their most recent quarterly results, which resulted in this drop here, they were already kind of on a downward trend throughout this year. So part of me thinks that investors were kind of anticipating this. And if we go back even further, we can see that Nike has actually been on a relative downward trend pretty much since the start of 2022. So it's been actually a few years now. And the level they're at now of about low 70s dollars per share, it's a level that we haven't seen for Nike since going back all the way to March of 2020. Now, despite this recent drop, there's no doubt that Nike is objectively still one of the strongest brands in the entire world. Forbes currently has them ranked as the 13th most valuable brand worldwide, and they still sell twice as many shoes annually as Adidas, which is their closest competitor. So in this video, I want to answer the question, does Nike at its current price present good value to investors? Is this an opportunity to invest in a high quality company at a good price? Or are the risks actually justified and we're now at a turning point in the storyline of the Nike brand? So the first thing I want to do is dive a bit deeper into their most recent quarterly earnings report and discuss what specifically is causing problems for them. And really, I think it's two things. One is the general slowdown in retail spending, specifically on high-end clothing items. And we've seen this in other companies as well. For example, Lululemon, who I talked about in a recent video, is also having similar issues. And Burberry, which is another European-based high-end retailer, recently reported a massive decline in revenue, which has actually prompted layoffs in the company. In fact, I went back and looked at 10 high-end clothing companies that are publicly traded to try and get an understanding of what these companies are reporting in terms of their revenue growth in the most recent quarter. And what we can see in this column here, which looks at the change in comparable sales growth year over year for their most recent quarter, it's pretty mixed results overall. As we can see, some companies have still actually been able to grow their revenue despite the macroeconomic challenges. For example, Ralph Lauren is one company which has 6% revenue growth. Nordstrom has still been able to grow their revenue. This European company with a name that I can't pronounce has also been able to grow their revenue 8% year over year, but still pretty mixed. There's more companies that are reporting very sharp declines in their sales on a year over year basis. And the CEO of a company called Capri Holdings was the only one who was actually brave enough to explain what's going on, which is that they're seeing softening demand globally for fashion luxury goods. And so it's no secret that across most of the developed world right now, interest rates are higher than they've been historically. Inflation has been high for a long time now, even though it's starting to show signs of coming down. And these things will put a drag on spending, especially in non-essential spending areas like spending on luxury fashion items, which is ultimately what Nike is. Nike's biggest regional markets are the United States, which makes up 43% of their total revenue, and China, which makes up 15%. The US, as we know, has been dealing with high inflation and high interest rates for a while now, which is causing the personal savings rate to decrease, which will naturally mean less sales for a company like Nike that is sensitive to recessions and changes in consumer spending. Even if we aren't technically in a recession at the moment, it still does feel like a recession for a lot of people. And China has been dealing with their own unique issues. About 3 years ago, China had a massive housing bubble that burst, and so property values decreased significantly. And this has this sort of wealth effect where declining property values will make people feel poorer, so they're trying to spend less money, they're trying to save more, which flows through into less sales for a company like Nike in China. And we can see in this chart here that Nike sales for China have been on a downward trend pretty much since 2022. So the fact of the matter is, Nike is a consumer discretionary company that will see sales decline when the economy starts to slow down. But this decline is something that we can rest assured will alleviate in due time, right? Because it's just the cyclical nature of the industry. Something that is a bit more concerning and potentially more permanent is the idea that competitors are starting to gain market share on Nike. So to understand this, it helps to have a little bit of history on Nike. So back in the year 2020, John Donahoe took over as the CEO, and he was someone with more of a tech background as he had previously worked at companies like PayPal, eBay, and ServiceNow. And one of the key strategy changes he brought was a digital transformation. He wanted to shift the sales split of Nike away from wholesale and more towards e-commerce and direct to consumer routes via their own Nike branded stores. And as a result, we saw sales from Nike Digital, which is their e-commerce channel, increase a lot relative to total revenue over the years. And they also want to drive more traffic into their own branded stores. So they cut ties with a lot of these smaller clothing retailers that they had worked with for many years, like Durham's, Shoe Show, Olympia, Big Five Sporting Goods. And why did they want to do this exactly? Well, because selling direct comes with higher margins. When you sell products through wholesale, the end retailer does take a percentage of your profit, which results in a slightly lower margin. So Nike can actually increase their margins by getting more customers to buy directly from them. But if we actually take a look at what Nike's operating margin has historically been, it's been pretty stagnant and hasn't really changed a lot. If anything, it's actually started to come down in the more recent years. But looking back over the past 10 years or so, it's been pretty consistently in that 12 to 14% range. Now, the other thing I want to look at is their gross profit margin, right? And pretty much the same story for this, where this has been pretty consistently in the mid 40% range. So, despite this change in strategy, they haven't actually seen it materialize just yet. So, what ended up happening from 2020 to 2023 was all of these retail stores that customers had become accustomed to shopping at, they started seeing Nike less and less at those stores, which allowed competitors to take market share. Nike's biggest competitors are obviously Adidas here at number one. They've been able to grow their revenue at 12% total over the past 3 years. And many other smaller shoe companies like Decker, On Holding, Asics, Skechers have still been able to grow their revenue at a much faster rate than Nike has over the past 3 years. So my question is, if the Nike brand is so strong and it does give the company this economic moat, then how could this move that they made of trying to shift sales away from the wholesale channel and more towards direct channels, how could that have caused them to lose market share? Why didn't they just maintain the same market share, but just have more sales come through those direct channels and get more people shopping on their online store or shopping in their in-person stores? Well, personally, I think the answer is that customers ultimately want selection when they shop. And if they're just seeing Nike less and less at areas that they've become accustomed to shopping at, and other options are starting to look better because maybe they're cheaper than Nike, and we're now at a time where saving money is becoming increasingly important, then I think naturally it's going to allow other companies to catch up. So, all that to me isn't really characteristic of a company with an economic moat. Now, to add a little bit more context to this argument of whether it's the macroeconomic conditions that are causing issues for Nike or if it's competitive pressures from other companies that are causing them issues, let's take a quick look at the most recent quarterly results of the company that owns the number one strongest brand in the entire world, and that is Apple. So Apple also sells high-end consumer products, typically at much higher price points than Nike is going to be selling at, and they sell pretty much exclusively through their own branded stores. So they do have some similarities to Nike in that sense. Their results actually look pretty similar to Nike because we can see in the Americas region here, their sales were pretty much stagnant, but overall were down slightly year over year. And then in the greater China region, their sales were down much more significantly on a year over year basis for this quarter. So it looks pretty similar overall. So what I think is actually happening here is Nike management just overestimated how much brand equity they actually have. And now they're trying to reverse that strategy and get back into some of those retailers that they had been working with before. But I don't think that the Nike brand itself has actually weakened very much because their results look pretty similar to Apple here, which is objectively a much stronger brand. And they look pretty similar to other high-end consumer products, like when we looked at certain fashion companies, high-end fashion companies previously. So I think their decline is probably more so to do with poor macro conditions across the entire world. Okay, so now I want to dig a little bit deeper into the financial side of Nike. And we're going to do this by taking a look at some financial ratios and comparing those to what the medians are for the industry. And the industry we're looking at is just other footwear companies. So we can see we have Deckers here, On Holding, Skechers, various footwear companies, even Crocs is included in here. So the first metric I like to look at would be return on invested capital. This is your best barometer for overall business quality. Companies that have strong brands should ideally have high returns on invested capital, and that's actually numeric evidence of the brand itself being strong. Because if their return on invested capital is basically the same as the industry, then they just simply do not have a strong brand. But in Nike's case, we can see it's 19% versus the industry median of 9%. So pretty much double what the industry is. And their margins are also generally slightly higher than the industry. We can see here their operating margin is 12% versus the industry of 10%, net profit margin 11% versus the industry of 8%. So this is, from we can tell, a above average business in terms of overall business quality for this industry that they operate in. But what usually comes with these kinds of businesses is they trade at a slight premium. And even after Nike has come down in price so much, 32% year to date, they still have a PE multiple that is much higher than the industry, and pretty much all valuation multiples are going to be high relative to the industry, right? So these things are all great, but these are backward looking metrics, right? And we want to value companies and actually assess if investing in a company is a good idea based off of what they're going to be in the future, right? Not just what they've been historically. If we just take a look at what Nike has been historically, we take historical revenue growth rates and project those out into the future, and we conclude that they're undervalued just based on that, then that's how you end up getting caught by value traps. So we have to actually dig a little bit deeper into what we think is reasonable for this company going forward. So let's now do an actual valuation of Nike. And we'll start in doing this valuation by doing a 5-year valuation. And I want to basically assume a no growth scenario. So I'm going to change the revenue growth to 0 and also assume that there's no changes in the company's operating margins or tax rate or anything really. Pretty much whatever the past 5 years looked for Nike is what the future is going to look like, just assuming no revenue growth there. The last thing I'm going to change though is their terminal multiple. I'm going to change this to 15. And if we take a look at what their terminal multiple is currently, it's at about 15, right? We can see here 15.57. So this is what it currently is. And we'll calculate it and see what the company gets valued at. So under this scenario, we would say that Nike is currently a little overvalued, right? So clearly at this price, their current price of $72.70, investors are still expecting some growth within this company. So they aren't super pessimistic, but they aren't super optimistic either. Now, what if we just change the revenue growth to basically what it's been over the past 5 years, which is about 3%? And we'll calculate that. And we can see when we do that, the company is pretty much bang on its intrinsic value. So this is pretty much what investors are valuing the company at. We didn't have to do a whole lot of work here to understand what kind of results people are expecting Nike to have. Basically, whatever happened in the last 5 years, they're expecting to happen again over the next 5 years. So anything that kind of deviates from that scenario would be our opportunity to understand if Nike is actually overvalued or if it's undervalued. Now, what I will say is that a 15x terminal multiple, which is the EV/EBITDA multiple that we're using here, historically for Nike, that's quite low, right? So this chart here is their EV/EBITDA multiple going back many years. And what we can kind of see, which is interesting, is that it's gone up slightly as the years have gone on. And you tend to see this with companies that you would qualify as having very high quality business models and strong brands, is that investors recognize that over time and they assign an increasingly large premium in terms of the valuation multiple to the company as the years go on. But overall, the average terminal multiple they've had over the past pretty much 12 years has been just under 20. It's been 19.98. So if we were to value Nike using that and we change it to from 15 to 20, then they're going to look significantly undervalued. Or not significantly, but they definitely look undervalued. But multiples that we value companies at depend on the expected future growth rates for whatever company, right? So Nike in this case. Now, until they can start to show signs of them growing in their core market, which is North America, also starting to grow in China as well at a rate that's higher than just 2% or 3%, then their multiple is probably going to stick in this 15%, in this 15x range, because investors won't really have a reason to reassess the company until they prove to investors that, things are starting to change, the tide is turning for them. So the question becomes, what is a reasonable expectation of the future revenue growth for Nike? Well, what I think is reasonable is, again, they said probably a decline for 2025 in the mid single digits, so we can say 5%. But then let's say they can return to growth mode after that, and they can grow at 5% annually for the next 5 years until 2029. Now, what's going to actually fuel this growth? Well, it will be, we can assume there's some growth just from inflation, right? Companies generally can raise their prices in accordance with inflation. So if inflation is 2 or 3%, then some of that growth is going to be from that. But then there's also this equipment business they have, which is much smaller relative to the size of the business overall, but it does make up a sizable share of the revenue, and it's one that is growing pretty fast. It's growing in the double digits annually. But overall, this scenario basically assumes that the Nike legacy businesses like apparel and footwear that they have, these all pretty much stagnate and there isn't a whole lot of growth in these. And really, any growth would just be from inflation, right? So if the economies that they operate in start to show signs that they're going to start to recover and that growth can actually be higher, then what we're probably going to see is investors re rate this company, reassess this company, and start to assign a higher multiple to it. Because right now it seems it's a pretty pessimistic scenario that is priced in for Nike, but not necessarily a scenario that I think is unreasonable. So, anyways, guys, that's my thoughts on this company. I hope you did find this useful and you learned something about Nike throughout this video. If you did, then please leave a like. And if you're new to my channel, I'd appreciate it if you consider subscribing. And I'll see you guys in the next video.